Last year, the public was given a rare glimpse into the financials of a professional sports franchise owner, and what they saw was truly astonishing. Tax records that were leaked by ProPublica showed that Steve Ballmer, the owner of one of the most lucrative franchises in sports, the LA Clippers, had managed to report $700 million in losses from 2014 to 2018. For one of America's biggest sports teams to be hemorrhaging money, naturally this turned heads.
When we step back and look at professional sports through the lens of economic terms, it's a business with revenues, taxes, shareholders, expenses.
And in any free market economy, a business that consistently operates at a loss will no longer be able to operate. Business 101. Today, pro sports teams rank among the most reliably lucrative, rapidly coveted investment opportunities there are. They've proved practically impervious to busts, recessions, foreclosure crises, and plagues that have at the very least stalled growth in other industries. Since 2002, all four of the U.S. major sports leagues have performed better than the S&P 500, and in some cases by a very wide margin. Here are the league's respective returns over the past 20 years. NBA, 1,057%, MLB, 669%, NFL, 558%, NHL 467%. So you might be thinking Steve Ballmer's LA Clippers are just a bad apple amongst a league of bona fide profit engines. Well, the truth of the matter is the Clippers aren't unique, and dozens of other sports franchises across every league are in this profitless boat together. So what is going on here? How can franchises like the Clippers consistently operate at a loss? Meanwhile, from 2012 to 2021, NBA valuations have increased 387%. The crazy thing about all this, the yielding losses these franchise owners are reporting to the IRS are almost entirely fake, and it's completely legal. If you're fascinated with the different types of tax loopholes individuals are able to get away with, look no further. The ownership circle in sports is an ideal playing ground for tax dodging. The moneyed elite have been quietly utilizing sports franchises to park billions of dollars of their wealth in an effort to shave millions of dollars of taxes annually. If you're interested in these types of videos, please take a moment to subscribe to this channel. Thanks so much. Today, sports owners have created a system to where their teams rise astronomically in value, but for tax purposes, nearly all of the assets that account for the value depreciate over time. To understand how this all works, it's important to explain the history of sports ownership and the laws that regulate it. What pro sports teams are to people who buy and sell them has changed dramatically over the years. Gone are the days when the industry attracted a certain type of brash and cunning entrepreneur. These weren't people who weren't necessarily lavishly wealthy, but would pour all their financial resources and unconventional business ideas into their teams, which sometimes impoverished them. Take Christian Friedrich Wilhelm von der Abe. In the late 1800s, this poor schmuck sunk his entire net worth into owning the St. Louis Brown Stockings. Von der Abe purchased the Brown Stockings not because he knew anything about baseball, but because the young men who patronized the saloon wouldn't stop talking about their games. He sought the ownership as a good investment and a chance at financial freedom. By 1892, the baseball team had fallen into 11th place in the 12-team league. Attendance had dwindled, and the new ballpark he had built for the Brown Stockings had mysteriously burned down. As the tragedy went, debts accumulated, his wife divorced him, bondsmen kidnapped him, and finally he lost the team to debtors. Not long after, he died of cirrhosis of the liver. It was commonly said in the early days of sports ownership, if you want to become a millionaire, become a multi-millionaire and then buy a sports team. The theme persisted of sports owners not making any money until Bill Veeck came on the scene in the 1940s. You may not know who he is, but he changed the sports industry forever. Veeck dreamed up an innovation to leverage sports franchises as tax shelters. He accomplished this by separately buying up the players' contracts before the old company was liquidated. This meant that the players' contracts were treated as a completely separate asset. The value a new owner assigned to that asset when he bought the team could be used to offset any taxes on team profits, as well as any other income he might have. Once the IRS accepted this premise, a new swath of savvy business owners flooded into sports. This was so revolutionary because no other industry has ever assigned a quantifiable value to the talent level of its employees, and then written them off as depreciable assets. You had owners claiming 90% or sometimes 100% of the team's purchase price to player contracts. The ambiguity of this law caused the IRS to battle these owners regarding how they valued their teams. It took until the early 1970s before the IRS finally began to look with some suspicion at what was going on in sports. In 1970, in what appears to be the first serious attempt by the IRS to limit or eliminate the Veeck tax shelter, they took a stand against Bud Selig, who had acquired the Seattle Pilots baseball franchise in hopes to move them to Milwaukee and rebrand them as the Brewers. He bought the team for $10.8 million and allocated $10.2 million to player contracts. In doing this, he assigned 94% of the purchase price to the players' contracts, depreciating the value of that asset over the course of 5 years to offset federal taxes. This would produce a tax shield of more than $2 million of income per year. The IRS fought him on this and ultimately brought him to court. In the end, the district court held that Selig's amortized deduction was proper. Following this case, this brought on a lot of endless litigation for sports leagues and the IRS. Until 1993, Congress inaugurated the modern era of amortization by simplifying simplifying the rules. Under the new regime, the purchaser of a business would be allowed over the course of 15 years to write off more types of intangible assets. The only issue? Congress explicitly excluded sports franchises from this law. But as you can imagine, this would all change. In 2004, following lobbying by Major League Baseball, sports teams were granted the right to use this deduction as part of a tax bill signed by President George W. Bush, himself a former part owner of the Texas Rangers. Coined as the everlasting tax shelter, this quietly changed the game for sports owners and served as the linchpin for skyrocketing values of sports franchises today. So here's how it all works. When billionaires buy teams, the law allows them to treat up to 90% of what they bought, including assets that don't lose value, as deteriorating over time. This includes things like player contracts, TV deals, which are virtually guaranteed to regenerate because sports franchises are essentially monopolies. For example, let's say you have a big tax bill coming up, and most billionaires do. You could, in theory, acquire a sports franchise. You purchase the new team for $2 billion and project the team will generate around $100 million annual of pre-tax related income, which is not unusual given the sports climate today with national and local TV media rights. So here's where the fun begins. Under normal circumstances, I would owe close to $40 million in taxes every year. But remember, there's no industry more detached from economic reality than professional sports. I now get to deduct $120 million annually, or 90% of the purchase price for the next 15 years. For my pre-tax income generated from the team I bought, as far as the IRS is concerned, on paper, my team is no longer generating $100 million of pre-tax income. Instead, it's losing $20 million annually. The $100 million of pre-tax profit isn't really lost. The cash is still sitting in my bank account, and I get to enjoy all of it tax-free. But it gets better. Because my team is structured as a pass-through entity or an S-corp, the extra $20 million amortization shield goes straight to my personal income tax return and shields other taxable income as well. By the time the 15 years expires, the shelter will save me from paying taxes on $1.8 billion of income, in aggregate saving me from paying up to $710 million in taxes. Let me say that again. Because I bought my team for $2 billion and made the typical purchase allocations, I will not have to pay $710 million in future taxes. This is a typical scenario for any sports transaction in today's age. For the average fan, sports is about wins and losses, championships and heroes. And for the CEO, the owner of the sports franchises, winning and losing is not determined by numbers on a scoreboard, but by valuations and profits. Whether it's unfair or not is purely subjective. One would argue that sports franchises are treated the same way as any other business, while others would say they inherently benefit as their assets are almost entirely intangible. Sports teams are just another tool billionaires use for the accumulation of wealth in an effort to ensure their money is working for them and not for some government somewhere.